everyone. Joe DiChiara, CPA, lifelong entrepreneur, coming to you with episode number 9 of How to Win Big at Business. And I mean big, meaning successful. I want you to be successful. When I say you, I'm talking to self-employed professionals because that's who I created this podcast for. And the reason for that is I'm a self-employed professional and it's treacherous. It can be a lonely road. Let's face it, when we go into business, usually there's nobody there to help us. Usually there's nobody there to mentor us, to coach us. We don't figure that stuff out until later when problems start happening. And inevitably, it's not if problems happen, it's when they happen. And right now, we're still in January and it's tax season. So I promised everybody the next in episode 8, I went through a bunch of things about taxes. And today I'm going to do the same thing. We're going to talk about some of the nuts and bolts that you can be doing to avoid all of that pain and suffering and most pain and suffering is self-inflicted. And I know this for a fact because I suffered from this. Not about taxes, obviously, because I'm a CPA, got hands-on experience for, right from the get-go. But I do remember before I went to school for accounting, guess who did my taxes? Because I did work, I did get W-2s. My mother did my taxes. And I didn't even know how it worked. All I knew was, and she did it by hand, and I always got a refund. I don't know why. It was never thousands of dollars because I didn't make that much. But my mother was doing the taxes. And I just remember the trepidation, like the anxiety of, when she's filling it out. I'm like, okay, am I getting money back? And if I am, how much? Or the worst part is, do I owe any money? Because that's a disaster. Luckily, my mother knew what she was doing. Okay, there was simple returns. I remember she used to do my friends' returns, and so anyway, I went to school for accounting. I got a job, and I learned all about preparing taxes and the tax business. So the anxiety, the pain and suffering that I went through, yeah, most of it was self-imposed. It was things that I could have avoided. And when it comes to your taxes, if you're suffering from anxiety, if you're confused, if you're burdened, if you're wondering, like you don't know what to deduct, you don't know what you can deduct, or even worse, you're afraid of too many deductions that are going to trigger a tax audit. Nobody wants a tax audit, especially in today's environment. But let me get into some practical steps that you could take to reduce the anxiety. So when I teach my students or one of my new team members, if we have a new team member, we have a whole onboarding system. And yeah, it's everything is systematized. And basically, that's what I'm going to talk to you about today. Systematizing your personal tax return. And how do you do that? Well, here's the first step. You got to do some investigation. You do investigation before you even start on this year's tax return. And the investigation starts with your last 2 years tax returns. So in the perfect world, you have the tax returns and you have all the backup documents. In the last episode, I talked about the third party payments. If you have a business, you should have your P&L on there if you're a sole proprietor. If you're an S Corp like you should be, you should have your K1 attached. if you have any other partnerships or S Corp interests, you should have all those documents together. And also, like I said in the last episode, all of those documents should be digital. In today's world, digital documents are cheap and easy. Every printer, I'm pretty sure just about every printer is also a scanner. Or you could even just use your phone and take pictures. It's so easy today. You don't have to deal with paper. So either way, if you have the paper documents, use the paper documents. If you have the digital, either way, what you want is you want the information. So the first thing you're going to do is just peruse the tax return. Look at pages 1 and 2. See what's on there. Look at what lines are filled out. Not just the line numbers, but look at the description to the left. For instance, if line 7, I believe line 7 is still wages, look at that line, wages. Underneath that should be interest and dividends and so on. So the first part of your return is going to be all of your income items. Now, what they've done is because there's a lot of different income items now, so they condensed it by moving a lot of the income items to a second schedule. Okay, so some of the income items will be on a separate schedule. But before you even go to that schedule, let's stick with page 1. So at the top of it is all your income items. The next section is your adjustments to income. Now, adjustments could be a lot of things. It could be a pension deduction, an IRA, student loan interest. So there's a bunch of adjustments to come down to what we call your adjusted gross income. Okay. Then if you go to page 2, you're going to have, if you have exemptions, you're gonna have the dependents on there. Also at the top of the page, that's where you're gonna have your dependents, your social security numbers, your addresses. So now we go to page 2, and that's where you come up with your taxable income. Then there's a tax, then there's a deduction or an addition if there's any tax credits or additional taxes. For instance, if you're self-employed and you had a profit, there's going to be social security taxes there. Then you come up with your total tax, and then at the bottom, there's going to be a lines to enter all your payments. So you could have payments from withholdings from your W-2. You could have withholdings from your 1099s. You could have estimated tax payments, and all of that goes there. And the bottom line is you're going to take your income tax, subtract the withholdings, and the difference is either your refund or how much you owe. So just spend 5 minutes, go through that, refresh your memory. Then you're going to go to the schedules. Okay, Schedule A, if you were lucky enough to itemize, not many people have been able to itemize in the past because of the SALT deduction, that state and local taxes. It was limited to 10,000 before 2025 tax returns. They changed the law. So now a lot more people are going to be able to itemize. But if you did itemize, you want to go through there. On the top are health-related deductions. Not many people can take health-related deductions because there's a limitation. It's limited to the first 7.5% of your income comes right off the top. So you got to have a lot of medical expenses, and I hope you don't, to be able to take a medical deduction. Then there's contributions, then there's the SALT deduction, state and local taxes. Then you actually, I think contributions are below that, but wherever it is, and they move these things around. And then at the bottom, they'll have other miscellaneous deductions, which I'm not even going to get into. But those are your itemized deductions. You also have two other schedules. One schedule is for other income. The other one is for other, I believe, other deductions and other taxes. Uh, I don't remember off the top of my head, to be honest with you. They move these things around from year to year. So that's why it's important for you to get familiar with that. So now you have an idea of what went on your prior return. That's half the battle. That's more than half the battle. Because when you finish your current year return, you're going to compare it to the previous year. Returns, personal returns, don't usually change from year to year. And that's one of the secrets to monitoring your taxes and avoiding all the pain and suffering. So, what's the purpose of doing this? Because the next step is to list all of the documents, all of the backup documents that went into putting all those numbers together. So, for instance, if you had mortgage interest, that's a 1098, put that on your list. You can't do your tax return unless that form comes in. But if you follow my steps, you're going to know what forms are missing. If you had the Obamacare, make sure you have it. Any 1099s, especially 1099Gs and student loan interest, which is a deduction, you're going to make a list of all the third party documents that you need to get before you file your return. Now, if you don't have a document, there's a chance it could have got lost in the mail or it's delayed. So, what you should do then is make sure it's not something you need to download from the internet. If it's not and you still don't have it, you got to call the payer. You got to call the payer. Now, especially when it comes to K1 and stock sale, they are notoriously delayed. In fact, we have clients with outside businesses or rental properties that they're investors in. And we just know, listen, the K1s aren't going to be ready. We need some kind of estimate or their profits or their losses to calculate if they're going to owe any taxes. So K1s and stock transactions are notoriously late. Not only that, you got to be careful because with stock transactions, a lot of times those 1099s are correct. So it's almost like a moving target. So if you have stock transactions, probably you're going to get them late and don't be surprised if they change. Now that doesn't mean you can't frame out your tax return. By all means do it, but I'm just advising you that if you have stocks and you know from prior years if they have a habit of reissuing them, wait to actually file the return. Frame it out, figure out if you owe taxes, if you're getting a refund, okay? You might want to go on extension. Another step, just because you received a third party statement, don't assume that it's correct. Don't assume that it's correct. One way of telling is to compare it to previous year and say, you know what, something's off. Now, I catch, and it's my job and my team's job to find discrepancies because we do this. We're looking at last year's stuff. We do everything that I just advised you to do. But you could make your accountant's job a lot easier and avoid a lot of mistakes if you also do. Okay, do your due diligence. So, what are some of the common mistakes? What I'm running across is incorrect retirement distribution. It happened to me. My ex-wife took a distribution from a retirement plan, and there was a box checked that said it was the result of a deceased spouse. And I said, you know, Teresa, this has to be corrected because obviously I'm not deceased yet. So that, you know, that was just a mistake. It happens all the time. Another client, this happened last year, they had him as making a contribution to an IRA. Well, the only problem with that is you have to have earned income. You have to have a W 2 or a business to contribute to an IRA. And he didn't have, they put it in the wrong box. So we had to contact them. I had to put him on extension. I framed out his tax return. We put him on extension. It took them about 4 months to correct. Because here's the thing, even though I knew it was incorrect and I knew what the correct numbers should be, you can't file it because that information also goes to the IRS. So if the IRS gets your return and it doesn't match the third party payers information, guess what you're going to get? You're going to get a bill in the mail, or you're going to get a letter that says your tax return doesn't match the third party pay. Now, you get a bill if the difference is in the IRS's favor. If it's in your favor, they're not going to send you a refund. What they're going to do is they're going to ask you to clarify this. Now, last but not least, everything for your personal tax return doesn't come from third party payers. For instance, contributions. A great write off are non-cash contributions. Now, what is that? That is obviously clothing, especially people with children. You know, the kids grow out of the old clothes. Instead of throwing it out or just putting it in a clothes bin, bring it to a charity and get a receipt. You need to have the receipt to take the tax deduction because I think if it's over $500, you have to put all of that organization's information in their tax ID number, their address. Then you have to put down the condition of the item. But I've had clients donate, yeah, furniture, obviously. And here's a good one, a library. I had a client, his wife passed away. She had a large library of books. She was a teacher. He had no use for them. They donated it and got a $15,000 write-off. Uh, Cars, there's a big industry in the US, I know, for charities that take cars. They even take real estate. They'll take just about anything. So non-cash contribution. What else? Other deductions. If you have, not many people have this anymore, but uh, if you're self-employed, well, that has to do with the business. So I'm not going to get into that. I already did that in episode 8. I already did that in episode 8. If you haven't listened to episode 8, go back. What? Well, I will talk about this. The office in the home deduction for self-employed individuals. So if you're a Schedule C, if you're a sole proprietor, I strongly, strongly suggest you consider converting to an S Corp. And this is one of the main reasons why. When you're a Schedule C, when you're a sole proprietor, there's a form that you have to fill out to deduct your office in the home expense. And they want to know everything. They want to know the square footage. They want to know, you know, your utilities. They want to know everything that you're deducting line by line. Now, why is that a problem? It's a huge red audit. What you're telling the IRS is, hey, listen, I'm taking my personal residence and I'm claiming it to be business use. I don't have any third party verification. I don't have a K1. I'm not going to give you my property tax. I'm not going to give you the receipt for all the furniture I put in there. I'm not going to give you the receipts for the painting and the repairs. I'm not going to give you the utilities. Just take my word. It's easy for the IRS to disallow that stuff. And if they decide to audit you, so what happens is, and the IRS will never tell you exactly how they choose audits, and they do it a bunch of different ways, but one way is they score it. And the higher your score, the worse it is for you. Office in the home for a self-employed person doesn't help. Now, if you're an S corp, there's no special form. It comes under what we call an accountable plan. And what that means is the corporation is going to reimburse you, the owner, the shareholder of the business, for the business use of your, and that's 1,000% legal. It's similar to when if you have a job and you go out, let's say you're a salesperson and you get reimbursed. And what you do, the way you get reimbursed is you give your employer an expense reimbursement form. It's the same thing if you have an S corp. So in Bedrock, what we've done is we created a spreadsheet. It we have a formula for the square footage, any other items like utilities, real estate, all of that becomes a business deduction. Anything that they spent specifically on the office becomes 100% deduction. That all goes on the sheet. You can do it quarterly, you can do it annually, whatever it is. Now, what we tell our clients is you could either actually reimburse yourself via a check from the business to them personally, or what we do is we do a journal entry and put it in as the business now owes them that money back. Because technically speaking, they they put the money in via using personal funds for business. Now, a lot of clients ask me, should I just pay my mortgage or rent through the business? And the answer is absolutely. You don't want to do that. If there's ever an audit, it's gonna stir up a lot of unnecessary questions. So that's all I got for today. That's my story. I'm sticking with it. God bless. I hope you learned something today. I hope I gave you some good info. If I did, follow me, like the podcast, tell your friends and family about it. I'm here to help people. If you want to book a chat with me, just go to Time with Joe. I'd be happy to talk to you about your business. And don't ask me about raising children or or relationships. That I can't answer questions about that. But if you do have questions about your business and taxes, that I can help you with. So again, that's my story. I'm sticking with it. How to win big at business. And I'll see you in the next episode. Thank you.